Every time an airplane takes off, thousands of people look at the sky. But very few think about the thousands of parts hidden inside that aircraft. We admire the airline. We notice the aircraft manufacturer. Maybe we recognize the logo of Airbus or Boeing painted on the body of the plane. But almost nobody wonders, who actually made the tools that built this aircraft? Who manufactured the precision components that help maintain engines worth millions of dollars? Who ensures that a single mistake doesn't become tomorrow's aviation headline? Surprisingly, some of those answers lead us not to America, not to Europe, but to factories quietly operating in India. Over the last decade, India has been trying to rewrite its manufacturing story. For years, the country was known primarily for software, IT services, and outsourcing. But governments don't become manufacturing powerhouses overnight. It requires policy, investment, infrastructure, and most importantly, companies capable of meeting world-class standards. That's where initiatives like Make in India, Atmanirbhar Bharat, and India's growing focus on aerospace and defense manufacturing begin to matter. These aren't just slogans. They're attempts to move India higher in the global value chain. Imagine a school project. One student writes the cover page. Another prepares the charts. A third researches the topic. But one student designs the entire presentation so well that everyone notices the final result. Countries work in a similar way. Some manufacture basic products. Others manufacture sophisticated machines. And a select few build components so precise that the rest of the world depends on them. India wants to become one of those countries. Now has something fascinating. Modern aircraft are among the most complex machines ever built. A commercial airplane contains millions of individual parts, thousands of suppliers, hundreds of certifications. Dozens of countries contribute to building a single aircraft. No company, not even Boeing or Airbus, manufactures everything themselves. Instead, they rely on a vast ecosystem of specialist suppliers. Some produce landing gear. Some produce avionics. Some manufacture engine parts. Others build the highly specialized tools used to assemble and maintain aircraft. And this is where a hidden world begins. Think about a Formula One racing team. Everyone notices the driver. But behind every winning driver stands hundreds of engineers. The same is true in aerospace. Passengers only see the aircraft. But hidden behind every successful flight are thousands of engineers working quietly in factories that most people have never heard of. Their names rarely appear in newspapers. Their products rarely appear on television. Yet without them, aircraft wouldn't fly safely. Now ask yourself a simple question. If a company manufactures precision parts for toys, replacing that supplier might be inconvenient. But if a company manufactures precision tooling for aircraft engines, can an airline simply switch suppliers tomorrow? Probably not, because aerospace isn't an industry built merely on price. It's built on trust. And trust in aerospace is earned over years, not weeks. Every component must pass rigorous testing. Every process must be documented. Every measurement must be accurate. Imagine undergoing a medical operation. Would you choose surgical instruments from an unknown manufacturer simply because they were cheaper? Of course not. Precision industries work the same way. Reliability matters more than cost. That's why aerospace companies often stay with trusted suppliers for years. Not because changing suppliers is impossible, but because the cost of making the wrong choice is far greater than the savings from a cheaper alternative. This creates an interesting investment lesson. Many investors spend all their time searching for the next famous company. But institutions often search differently. Instead of asking, which company is popular? They ask, which company is quietly becoming indispensable? There's a big difference. Popularity can change in months. Becoming indispensable often takes decades. And markets usually notice that transformation much later than businesses create it. Today, we're exploring one such company. a company that most retail investors had never heard of a few years ago. Yet its products travel across continents. Its customers include some of the biggest names in global aerospace, and it operates in industries where precision is not just appreciated, it's mandatory. This company is Unimech Aerospace and Manufacturing Ltd. At first glance, it may look like another listed engineering company. But as we peel back the layers, we'll discover a business sitting quietly at the intersection of aerospace, defense, semiconductor manufacturing, and high-precision engineering. More importantly, we'll discover why businesses like this sometimes move from being almost invisible to becoming closely watched by long-term institutional investors. But before we understand Unimech itself, we need to understand the industry it serves. Because in investing, great companies are often created by great industries. And sometimes, the biggest opportunity isn't the company everyone is talking about. It's the one quietly solving problems that the world cannot afford to ignore. So, let's begin our journey, not inside a stock market, but inside the fascinating world of aerospace manufacturing, where every micron matters, every certification tells a story, and every successful flight begins long before an aircraft ever leaves the runway. Why the world needs companies like Unimech. Imagine waking up tomorrow morning and hearing this headline. All commercial flights across the world have been suspended. Not because airplanes are unavailable, but because there aren't enough certified components and maintenance tools. It sounds unbelievable. But here's the truth most people never realize. An aircraft doesn't stop flying only when an engine fails. Sometimes, it cannot even take off because a tiny certified component is unavailable. Sometimes, a maintenance tool is overdue for replacement. Sometimes, a precision gauge fails inspection. And sometimes, a delay worth a few $100s can keep an aircraft worth hundreds of millions of dollars grounded. Welcome to the fascinating economics of the aerospace industry. When we think about aviation, our minds usually jump to airlines. We think of Indigo, Air India, Emirates, Singapore Airlines, or perhaps manufacturers like Airbus and Boeing. But those companies represent only the visible tip of an enormous industrial iceberg. Hidden beneath them is an ecosystem of thousands of specialized businesses. Some manufacture titanium brackets, some produce turbine blades, some build landing gear, others create electronic systems that pilots rely on every second. And then there are companies that manufacture something even less visible, but equally essential. They manufacture the tools that build, inspect, repair, and maintain aircraft. Think about building a skyscraper. Everyone admires the finished building. Few people notice the cranes, scaffolding, surveying instruments, or specialized equipment that made construction possible. Without those tools, the building could never exist. Aircraft manufacturing works exactly the same way. Here's a mental model worth remembering. Imagine trying to assemble a luxury Swiss watch using ordinary household tools. You may have the right parts. You may have skilled workers. But without precision instruments, even the best craftsmen cannot produce perfection. Now multiply that challenge millions of times. That's aerospace manufacturing. Every hole drilled, every bolt tightened, every surface inspected, every engine repaired, every component tested. Everything must meet microscopic levels of precision. Because in aviation, a difference measured in fractions of a millimeter can determine whether an aircraft flies safely for decades or never leaves the ground. This is why aerospace isn't just another manufacturing business. It's a trust business disguised as manufacturing. Now let's understand something investors often overlook. People assume that companies compete mainly on price. In many industries, that's true. If you're buying office furniture or household appliances, switching suppliers may not be difficult. But aerospace follows completely different rules. Suppose Airbus has approved a supplier after years of testing. Engineers have inspected its factory. Auditors have examined its quality systems. Every manufacturing process has been documented. Every employee has been trained. Now ask yourself, would Airbus replace that supplier simply because another company offered a slightly lower price? Probably not. Because changing suppliers doesn't mean changing only invoices. It means restarting qualification, conducting fresh inspections, repeating safety testing, revalidating production processes, training engineers again, updating documentation. That process can take years. Suddenly, what looked like an expensive supplier may actually become the cheaper option. This is called switching cost. A switching cost isn't the money spent buying a new product. It's everything you lose by changing. The higher the switching cost, the stronger the business moat. And aerospace happens to be one of the industries with the highest switching costs in the world. Now another question. If the aerospace industry is so attractive, why doesn't every engineering company enter it? The answer is surprisingly simple. Because money can build factories. But money alone cannot buy trust. Imagine becoming a surgeon. You cannot simply purchase medical equipment and start performing heart surgery tomorrow. You need education, training, experience, certification, years of practice. The aerospace industry works the same way. Companies spend years building manufacturing capabilities before winning even a single meaningful contract. This creates a natural barrier to entry. It protects existing qualified suppliers. And that's precisely why investors often pay premium valuations for businesses that successfully enter these ecosystems. Another interesting feature of this industry is that success usually compounds. Let's say a company successfully supplies tooling to one global aerospace customer. What happens next? That achievement becomes more than just revenue. It becomes credibility. And credibility attracts attention from other customers. Think of it like a university degree. Once you've graduated from one prestigious institution, employers begin looking at you differently. Similarly, once an engineering company earns the confidence of a world-class aerospace manufacturer, new opportunities often become easier to access. One relationship leads to another. One qualification opens another door. One successful project creates the confidence needed for the next. That's why businesses like these sometimes grow quietly for years before the market fully recognizes what has changed. But every great industry also carries its own challenges. Aircraft demand moves in cycles. Global recessions can reduce airline expansion. Raw material prices fluctuate. Certification standards become stricter every year. Customer expectations continue rising. A single quality failure can damage years of reputation. In other words, the same industry that offers high rewards also demands relentless discipline. Only companies capable of maintaining quality, investing continuously in technology, and executing consistently survive over long periods. This brings us naturally to the company at the center of today's story. Unimech didn't become relevant simply because aerospace is growing. Many businesses operate in attractive industries, yet never become leaders. What makes Unimech interesting is its attempt to position itself where precision matters most, manufacturing complex tooling, precision components, and mechanical assemblies for global aerospace, defense, power generation, and semiconductor customers. Instead of competing in crowded commodity markets, it has chosen a field where expertise, certification, and reliability matter more than scale alone. And that's an entirely different game. Because when a company begins solving problems that only a handful of businesses in the world can solve, it gradually shifts from being just another manufacturer to becoming a strategic partner. Technical capabilities into decades of compounding growth? To answer that, we first need to step inside the company itself. Who founded it? What exactly does it manufacture? How does it earn its revenue? And why have some of the world's largest aerospace companies chosen to work with an engineering business from India? That's where our story goes next. The company nobody saw coming. If I asked you to name India's largest IT company, chances are you'd immediately think of Infosys or TCS. If I asked you about India's largest automobile manufacturer, names like Maruti Suzuki or Tata Motors would probably come to mind. But here's a different question. Can you name even one Indian company that manufactures high-precision aerospace tooling for Airbus, Boeing, Rolls-Royce, GE, or Dassault? For most people, the answer is silence. Not because such companies don't exist, but because they operate far away from public attention. And that's where today's story becomes fascinating. Sometimes, the biggest opportunities are not hidden because companies are secretive. They're hidden because their customers are businesses, not consumers. Think about your own daily life. You probably know the brands of your mobile phone, your car, or your television. But do you know who manufactured the robotic arm that assembled your car? Or who made the calibration tools used inside a semiconductor factory? Probably not. Because these companies don't advertise on television. They don't sponsor cricket tournaments. They don't compete for consumer attention. They compete for something much more valuable. The trust of global industrial giants. That is exactly where Unimech Aerospace and Manufacturing Ltd has positioned itself. At first glance, the company may look like another engineering manufacturer. But if we look deeper, its role is very different. Imagine trying to build a Formula 1 racing car. The driver alone cannot win. The engine alone cannot win. Even the world's best mechanic cannot assemble the car without specialized tools designed for extreme precision. Now replace Formula 1 with aerospace. The principle remains exactly the same. Before an aircraft can fly, someone has to manufacture the tools that make manufacturing possible. Someone has to build fixtures that hold components with microscopic accuracy. Someone has to manufacture gauges that verify tolerances. Someone has to produce precision assemblies that eventually become part of aircraft engines, defense equipment, or advanced industrial systems. That someone is where Unimech earns its place in the value chain. Notice something interesting. The company isn't trying to manufacture an entire aircraft. It isn't trying to compete with Boeing. It isn't trying to become another Airbus. Instead, it has chosen to become exceptionally good at a small but extremely critical part of the ecosystem. There's an important investing lesson hidden here. Many businesses fail because they try to do everything. The strongest businesses often become specialists. Imagine visiting a hospital. Would you rather consult a doctor who claims to treat every disease, or a surgeon who has spent 20 years performing only one type of complex operation? Most of us instinctively trust the specialist. Industries think the same way. Large aerospace companies don't necessarily want hundreds of average suppliers. They want a handful of suppliers who have mastered one difficult job. Specialization creates trust, and trust creates long-term relationships. Let's simplify the business model. Unimech essentially earns money in three ways. First, it manufactures aerospace tooling. These are highly specialized tools used during aircraft manufacturing, maintenance, repair, and overhaul. Without these tools, technicians cannot perform many critical operations safely and accurately. Second, it manufactures precision-engineered components. These components are produced to extremely tight tolerances where even the smallest variation can make a product unacceptable. Third, it manufactures mechanical assemblies where multiple precision parts are integrated into ready-to-use systems for customers. Think of it like building with Lego blocks. One company manufactures the individual blocks. Another company assembles those blocks into complete modules. Customers save time because they receive solutions rather than loose parts. This increases value addition. And generally, higher value addition often leads to better margins. But perhaps the most interesting part of Unimech's story isn't what it manufactures. It's who buys those products. Its customers include some of the biggest names in global aerospace. Companies that don't choose suppliers casually. Winning such customers isn't like winning a normal purchase order. It's closer to earning admission into an exclusive club. Before becoming an approved supplier, companies undergo extensive qualification. Factories are audited. Processes are documented. Machines are inspected. Employees are trained. Quality systems are verified. Every step is examined. This qualification process can take years. Once approved, however, something remarkable happens. The relationship often becomes far more durable than in ordinary manufacturing industries. Why? Because replacing a qualified supplier means repeating the entire process again. And that's expensive. Not only financially, but also in terms of time, engineering effort, regulatory compliance, and operational risk. This creates a powerful competitive advantage that doesn't appear directly on a balance sheet. This is what investors call an economic moat. Let's define that in simple language. An economic moat is anything that makes it difficult for competitors to take away a company's customers. Imagine two castles. One stands on open land. The other is surrounded by a deep moat filled with water. Which castle is easier to attack? Obviously the first one. Businesses work the same way. Companies protected by strong moats are generally harder to disrupt. For Unimech, the moat doesn't come from a famous consumer brand. It comes from precision manufacturing capabilities, certifications, customer confidence, engineering expertise, and years of qualification. Those advantages are difficult to replicate quickly. Of course, no business is perfect. Being a specialist also brings concentration risk. If the aerospace industry slows, growth can slow. If a major customer delays orders, financial performance can become uneven. And because aerospace projects often involve long production cycles, quarterly numbers may not always move in a straight line. This is one reason why investors should focus less on individual quarters and more on whether the company continues strengthening its capabilities, expanding customer relationships, and deepening its competitive position. Now here's the part that many investors miss. When people hear the word manufacturing, they often imagine factories competing mainly on price. But Unimech is not competing to become the cheapest manufacturer. Its real competition is to become the most reliable engineering partner. There's a huge difference. Cheap suppliers can be replaced. Trusted partners become part of the customer's long-term planning. And that's precisely where long-term wealth creation often begins. Because businesses rarely become extraordinary by selling more products alone. They become extraordinary when customers begin depending on them. As we move forward, an even bigger question emerges. A great business model is only one piece of the puzzle. Even the best companies can struggle if they operate in the wrong environment. So before we dive into the financial numbers, management decisions, and market psychology, we need to understand something much larger. Why is the world suddenly paying so much attention to aerospace, defense, precision engineering, and semiconductor manufacturing? Because sometimes, a company's biggest growth driver isn't inside its factory. It's the powerful global forces quietly reshaping the industry around it. And those forces are exactly what we'll uncover in the next chapter. The whys behind the wings. Here's a question most investors never ask. Why would a company manufacturing precision aerospace components suddenly become more valuable? Even before it builds a single new factory? The answer is simple. Sometimes, businesses don't change first. The world changes first. And when the world changes, entire industries quietly become more valuable. Imagine you own a small tea shop on a deserted road. For years, business is average. Then one day the government announces a new metro station exactly outside your shop. Did you suddenly become a better tea maker? No. Your tea hasn't changed. Your recipes haven't changed. Your staff hasn't changed. What changed was the environment around you. Now thousands of commuters pass your shop every day. The value of your business rises, not because of what happened inside your shop, but because of what happened outside it. The same principle applies to industries. Sometimes governments, technology, geopolitics, and global supply chains create powerful tailwinds that lift entire sectors. and aerospace is currently riding several of those winds. The world is flying again, and faster than ever. Let's begin with a simple observation. Every year, millions of people fly for work, tourism, education, business, and family. As incomes rise across emerging economies, more people choose airplanes instead of trains or ships for long-distance travel. That means airlines need more aircraft. More aircraft means more engines. More engines require more components. More components require more tooling. More tooling requires companies capable of manufacturing them with extreme precision. Notice something interesting. Unimech doesn't need every passenger to know its name. It only needs global aircraft manufacturers to keep building airplanes. It's like the company selling cement during a construction boom. Homebuyers may never know which cement manufacturer supplied the building. But without cement, the building cannot exist. The defense revolution. Now another force is reshaping the industry. Around the world, governments are increasing defense spending. Countries are investing in fighter aircraft, military helicopters, missile systems, naval aviation, advanced electronics, and indigenous defense manufacturing. India is no exception. The country's defense strategy has increasingly focused on reducing dependence on imports while encouraging domestic manufacturing. This isn't just about national security. It's also about building industrial capability. Every defense aircraft, every radar, every missile launcher, every precision-guided system requires hundreds of precision-engineered components. Many of those components must meet standards even stricter than commercial aerospace. For companies already experienced in precision manufacturing, this creates an entirely new opportunity. It's like an experienced architect suddenly finding demand not only for homes, but also for airports, hospitals, and smart cities. The skill remains similar. The market becomes much larger. China plus one, a quite global shift. Now let's discuss one of the biggest changes happening in global manufacturing. For decades, much of the world's manufacturing was concentrated in China. Companies preferred a single large manufacturing hub because it reduced costs and simplified supply chains. Then reality changed. Trade tensions, pandemics, logistics disruptions, geopolitical uncertainty. Suddenly, relying on one country started looking risky. Imagine owning a restaurant that buys vegetables from only one farmer. If that farmer faces a drought, your restaurant struggles. Most restaurant owners would naturally prefer multiple suppliers. Global corporations now think the same way. This strategy has become known as China plus one. Instead of depending entirely on one manufacturing destination, companies are diversifying production across multiple countries. India has emerged as one of the biggest beneficiaries of this trend, and companies capable of meeting international quality standards suddenly find themselves competing on a much larger global stage. This doesn't guarantee success, but it certainly increases opportunity. Why aerospace isn't a commodity business? Here's another fascinating difference. Many manufacturing industries compete primarily on price, but aerospace rarely works that way. Let's imagine two suppliers. One offers a component for 95 rupees. Another charges 100 rupees. Would an aircraft manufacturer automatically choose the cheaper supplier? Probably not, because the cost of a faulty component is far greater than the 5 rupees saved. In aviation, reliability has value. Consistency has value. Certification has value. Quality has value. This creates an industry where companies with proven capabilities often compete on trust rather than discounts. And trust usually produces healthier margins than price wars. Semiconductors, another engine of growth. Now let's leave aviation for a moment. Think about your smartphone, your laptop, your car, even your washing machine. Almost everything around us now contains semiconductor chips. As the digital economy expands, demand for semiconductor manufacturing equipment also rises, and semiconductor factories require some of the most precise engineering in the world. Tiny errors measured in microns can affect production. That means companies already skilled in high-precision machining possess capabilities that are valuable beyond aerospace. It's similar to a master chef. A chef trained in one world-class kitchen can often adapt those skills to another premium restaurant. The techniques remain valuable across multiple environments. This gives companies like Unimech the ability to participate in several high-growth industries using similar engineering expertise. Renewable energy and power generation. Precision engineering doesn't stop at aircraft and semiconductors. Modern power plants, gas turbines, clean energy infrastructure, advanced industrial equipment, all require highly engineered components. As countries invest in energy transition and infrastructure modernization, demand for sophisticated manufacturing capabilities expands. Instead of depending on one industry alone, a company gradually builds multiple engines of growth. That's important because diversified demand can make earnings more resilient over long periods. But every tailwind has a headwind. Now, it's easy to become excited when hearing about all these opportunities. But good investors always ask the opposite question. What could go wrong? Because every attractive industry also carries hidden risks. Commercial aviation moves in cycles. During global recessions, airlines often postpone aircraft purchases. Raw material prices can fluctuate sharply. Currency movements affect export profitability. Certification requirements become increasingly demanding. Customer qualification takes years. And technological disruption never stops. Imagine running a marathon while the finish line keeps moving farther away. That's how precision engineering often feels. Companies must continuously improve just to remain competitive. Standing still is not an option. The invisible advantage. Here's perhaps the most powerful idea from this chapter. Industries don't create wealth automatically. They create opportunities. Whether those opportunities become shareholder wealth depends entirely on execution. Think of two farmers receiving equally fertile land. One studies irrigation, improves seeds, protects crops, invests patiently. The other neglects the farm. The land is identical. The outcomes are completely different. Industries work exactly the same way. The aerospace sector may enjoy powerful global tailwinds. Government policies may support manufacturing. Export opportunities may expand. But only companies capable of converting these opportunities into sustainable earnings will truly create long-term wealth. And that's where our story becomes even more interesting. Because the next question isn't about the industry anymore. It's about execution. Can Unimech actually convert these global opportunities into profits? Can management allocate capital wisely? Can the business continue strengthening its competitive position while maintaining financial discipline? Because in investing, a great industry may open the door, but it's management that decides how far the company walks through it. And that's exactly where our journey takes us next. The people behind the precision. Have you ever wondered why two companies can manufacture almost the same product, yet one becomes a billion-dollar enterprise while the other struggles to survive? Most people immediately answer, technology. Others say, money. Some believe it's marketing. But after studying businesses for decades, investors like Warren Buffett, Charlie Munger, and Peter Lynch repeatedly arrived at a different conclusion. Businesses are ultimately reflections of the people running them. Factories don't make decisions. Machines don't decide where to invest. Balance sheets don't negotiate contracts. People do. And in industries where a single mistake can cost millions of dollars, management quality often becomes more valuable than the machinery itself. Imagine you're about to board an aircraft. Before takeoff, the pilot announces, "Good morning, everyone. Today you'll be flying with someone who bought the world's most expensive airplane yesterday." Would that make you feel safe? Probably not. Now imagine another announcement. Today's aircraft isn't the newest one in the fleet, but your captain has safely completed over 10,000 flying hours. Suddenly, you feel much more comfortable because experience creates confidence. The same principle applies to businesses. Investors aren't simply buying factories. They're placing trust in the judgment of the people making thousands of decisions every year. Now let's bring that idea back to Unimech. At first glance, many investors focus on its products. Precision components, aerospace tooling, mechanical assemblies. But those are only the visible outcomes. The invisible engine behind every successful engineering company is management's ability to make the right decisions long before the market notices the results. And that's where Unimech's story becomes interesting. Look carefully at the company's journey. It didn't try to become everything for everyone. Instead, it steadily built expertise in areas where precision, quality, and reliability matter more than sheer production volume. That's rarely an accident. It usually reflects management making a conscious strategic choice. Think about a restaurant. One owner tries to serve Chinese food, Italian food, South Indian food, Mexican food, and desserts all under one roof. Another restaurant serves only one cuisine but becomes famous for it. Which restaurant is more likely to build a loyal customer base? Usually, the specialist. Management's first responsibility is deciding what not to do. Sometimes saying no creates more value than saying yes. Now let's talk about something many investors underestimate: capital allocation. It sounds complicated, but it isn't. Imagine you own a small grocery shop. At the end of every year, your business earns some profit. You now have several choices. You could renovate the shop, open another branch, buy a delivery vehicle, repay debt, or simply keep the cash in the bank. Every option changes your future. Running a listed company is no different. Management constantly decides where each rupee should go, and those decisions eventually determine shareholder returns. This is where Unimech appears to be entering an important phase. Following its IPO, the company has access to significantly more capital. The obvious question becomes, what will management do with that money? According to its stated plans, the funds are intended for expanding manufacturing capacity, strengthening working capital, investing in subsidiaries, and pursuing acquisitions and strategic initiatives. That sounds exciting, but experienced investors know something important. Raising money is easy. Deploying it wisely is much harder. History is full of companies that raised enormous capital, only to destroy shareholder wealth through poor investments. The real test begins after the money arrives. And here's where another interesting chapter unfolds. Instead of simply expanding its existing factory, Unimech has started broadening its industrial ecosystem. The company announced a long-term supply agreement with FACC, established a joint venture in Saudi Arabia, acquired Hobel Billows after the financial year ended, and incorporated a renewable energy subsidiary. These moves suggest management is looking beyond its current product portfolio toward broader precision engineering opportunities. Think about a successful cricketer. Initially, he scores runs. Later, he becomes captain. Eventually, he builds an entire team. Businesses evolve in a similar way. Initially, they manufacture products. Later, they build capabilities. Eventually, they build ecosystems. The question investors should ask isn't simply, did the company make another acquisition? The better question is, does every new investment strengthen the company's competitive advantage? Now let's discuss another management quality that rarely appears in annual reports: patience. Modern markets reward speed, quarterly earnings, daily share prices, minute-by-minute news. Everything encourages short-term thinking. But aerospace operates on a completely different clock. Customer qualification can take years. Factories require years to reach optimal utilization. Relationships dip in gradually. Expansion projects rarely deliver instant returns. Imagine planting a mango tree. You don't expect fruit next month. You water it, protect it, wait patiently, Only then does it begin producing harvests year after year. Industrial businesses often work the same way. Good management understands that today's investment may not produce visible results until several years later. But management quality isn't measured only during good times. It's measured during difficult times. Can leaders remain disciplined when demand slows? Can they avoid chasing risky growth? Can they maintain quality while expanding capacity? Can they balance ambition with financial prudence? Those questions matter more than any motivational speech delivered at an investor conference. Because confidence is easy when everything is going well. Character becomes visible when challenges appear. Another encouraging sign is that the promoters continue to hold a significant ownership stake. When founders retain substantial ownership, their financial interests remain closely linked with long-term shareholder outcomes. Of course, promoter ownership alone doesn't guarantee success, but it often encourages decisions that create lasting value rather than focusing solely on short-term earnings. Now comes one of the most important lessons for every investor. Many people assume management's job is to increase profits every quarter. Actually, that's only a small part of the role. The real responsibility is building a business that becomes stronger every year. Sometimes that means sacrificing short-term profits to invest in future capacity. Sometimes it means accepting temporary pressure on financial ratios while building capabilities that competitors cannot easily replicate. Those decisions can look disappointing in the short run, but prove highly rewarding over a decade. That's why institutions often spend more time evaluating management quality than quarterly earnings. Numbers describe the past. Management decisions shape the future. As we reach the end of this chapter, we've learned something fascinating. Unimech's story isn't only about machines, or factories, or aerospace. It's about leadership, making a series of decisions that gradually move the company from being a supplier to becoming a trusted engineering partner in industries where reliability matters above everything else. But good leadership alone isn't enough. Every vision eventually reaches a moment of truth. The numbers. Do the financial statements actually support the story? Is revenue growing because demand is strengthening? Are profits translating into cash? Is the company creating real economic value? Or merely creating an attractive narrative? Because in investing, stories capture attention. Financial statements reveal whether the story is becoming reality. And that's exactly where we turn next. Numbers tell stories. If you know how to read them. Imagine meeting to students after an examination. The first student proudly says, "I scored 95 marks. The second student quietly says, "I scored 82 marks. But last year I scored only 52. Now here's the interesting question. Which student has the brighter future? Most people immediately choose the student who scored 95. But an experienced teacher pauses before answering. Because numbers alone never tell the full story. The teacher asks another question. Who is improving faster? Investing works exactly the same way. The stock market isn't just interested in companies making money today. It is constantly searching for businesses whose future is becoming better than their past. That is why experienced investors don't merely read financial statements. They read the story hidden inside those numbers. Revenue is like the heartbeat of a business. Let's begin with the most familiar number. Revenue. Most people think revenue simply means sales. That's true. But here's a better way to think about it. Imagine owning a restaurant. Every customer who walks through the door adds to your daily sales. If more customers arrive every month, your revenue grows. But suppose customers stop visiting. Eventually, everything else starts weakening. Revenue is therefore like the heartbeat of a business. A healthy heartbeat doesn't guarantee perfect health. But without it, nothing else survives for long. Now look at Unimech. Over the last few years, revenue has expanded rapidly. The business has grown from a relatively small engineering company into one serving increasingly sophisticated global customers. A 3-year sales growth rate of roughly 37% isn't simply a statistic. It tells us something much more important. Customers are returning, orders are increasing, capabilities are expanding, and the company is gradually occupying a larger space in its industry. Revenue growth is good, but profits matter more. Now imagine two shopkeepers. One sells goods worth 100 rupees every day, but earns only 2 rupees. The other sells goods worth 70 rupees every day, but earns 20 rupees. Who has the stronger business? Clearly, the second shopkeeper, because profit is what remains after paying everyone's bills. This is where many investors make their first mistake. They celebrate revenue growth without asking, is the company actually making more money? Fortunately, Unimech hasn't merely increased sales. It has also expanded profits over the last few years. Profit has grown significantly alongside revenue. That tells us something encouraging. Growth isn't being purchased at any cost. The business has managed to expand while remaining profitable. Margins reveal pricing power. Now let's introduce one of the most misunderstood words in finance. Operating margin. Forget the formula. Imagine you're selling mangoes. You buy them for 80 rupees. You sell them for 100 rupees. Before paying rent, salaries, electricity and taxes, you have 20 rupee left. That leftover amount represents your operating strength. Businesses with higher margins usually poses one or more advantages. Better technology, better products, better efficiency, or stronger customer trust. Unimech has consistently reported operating margins that many manufacturing companies would envy. That doesn't happen by accident. It suggests customers are paying not merely for metal, but for engineering capability. And capability generally commands better pricing than commodities. Cash is the difference between profit and reality. Now comes one of Warren Buffett's favorite ideas. Profit is an opinion. Cash is a fact. Imagine your neighbor tells you, I've sold my house for 1 crore rupees. You congratulate him. Then he quietly adds, the buyer will pay me after 5 years. Suddenly, the situation looks different. On paper, he's rich. In reality, he still doesn't have the money. Businesses face the same challenge. Companies may report profits, but if customers delay payments or inventory keeps increasing, cash doesn't arrive. That's why experienced investors always follow cash flow. For Unimech, operating cash flow has remained positive. That's encouraging because it tells us profits are not existing only on paper. Money is actually entering the business. The working capital puzzle. Now let's discuss the one number that deserves serious attention. Working capital. This sounds complicated, but imagine running a bakery. Every morning you buy flour, then butter, sugar, milk. You pay your suppliers immediately. But your biggest customer says, I'll pay you after 4 months. Now imagine business grows rapidly. You'll need more flour, more sugar, more workers, more inventory. But the cash is still stuck with customers. Suddenly, growth itself begins consuming cash. That's exactly what working capital measures. In Unimech's case, working capital requirements have increased significantly. This doesn't automatically mean something is wrong. Rapidly growing engineering companies often require larger inventories and longer project cycles. However, it is one metric investors should continue watching, because great businesses eventually convert growth into efficient cash generation. Debt, a powerful servant, a dangerous master. Let's imagine two friends. Both decide to start restaurants. One borrows carefully. The other borrows aggressively. Initially, the heavily borrowed restaurant grows faster. Bigger kitchen, better furniture, prime location. Everything looks impressive. Then business slows. Now one owner is worrying about customers. The other is worrying about loan repayments. That's why debt deserves respect. Debt isn't bad. Excessive debt is. Fortunately, Unimech currently carries relatively low financial leverage. Its debt remains manageable compared to many capital-intensive manufacturing companies. That gives management greater flexibility during uncertain periods. ROEs, the CEO's report card. Now comes my favorite financial ratio. Return on capital employed. Or simply, ROEs. Imagine giving two chefs identical kitchens. Each receives the same equipment, the same staff, the same investment. After 1 year, one chef earns 50 lakh rupees. The other earns 10 lakh rupees. Who used the kitchen more efficiently? Obviously, the first chef. ROEs measures something very similar. It asks for every rupee invested in the business. How efficiently is management generating operating profit? Historically, Unimech delivered exceptionally high ROEs. Recently, that number has moderated. Should investors panic? Not necessarily. Remember, the company has recently expanded capacity, raised IPO funds, invested in future growth. New factories and new machines usually begin by increasing capital employed. Returns often improve only after those assets start producing at full capacity. So rather than reacting emotionally, the better question becomes, will these investments generate stronger returns over the next few years? That's the question institutions are likely asking today. The other income question. Now let's discuss something that careful investors never ignore. Other income. Imagine a restaurant owner proudly saying, "This year our profits doubled." Wonderful. Then you discover half the profit came from selling an old building. Suddenly, the picture changes because selling buildings isn't the restaurant's main business. Similarly, when analyzing any company, always separate operating performance from one-time gains. That doesn't mean other income is bad. It simply means sustainable wealth usually comes from the core business continuing to grow. Financial statements are like medical reports. Imagine visiting a doctor. Your blood pressure is normal. Sugar is healthy. Heart function is good. But cholesterol has started rising. Would the doctor say, "Everything is perfect"? No. He would say, "Overall health is good. But this one indicator needs monitoring." That's exactly how investors should analyze companies. For Unimech, many financial indicators look encouraging. Revenue growth, profit growth, healthy operating margins, positive operating cash flow, low leverage. At the same time, working capital efficiency and future return on capital deserve continued attention. This isn't a contradiction. It's simply balanced analysis. No great business is perfect. The best companies are those where strengths continue improving faster than weaknesses. And that brings us to perhaps the most fascinating part of investing. Numbers explain what has happened, but markets don't reward the past. They price the future, which raises a much bigger question. If the business is improving, if earnings are growing, why does the market sometimes value one company at 20 times earnings and another at 100 times? What exactly is the market paying for? Is it today's profits, tomorrow's possibilities, or something even more subtle? Because understanding valuation is where investing transforms from arithmetic into psychology. And that's exactly where our journey goes next. Why does the market pay 100 rupees for 1 rupee of earnings? Imagine two mango trees standing side by side. The first tree is fully grown. Every summer, it gives you 100 mangoes. But year after year, it produces almost the same number. The second tree is much smaller. This year, it gives only 20 mangoes. Next year, maybe 40. 5 years later, perhaps 200. Now imagine someone wants to buy one of these trees. Which one deserves a higher price? Most people immediately choose the tree producing 100 mangoes. But experienced farmers hesitate. Because they aren't buying today's harvest. They're buying the next 20 years of harvests. That is exactly how valuation works. The stock market doesn't buy today's profits. It buys tomorrow's possibilities. The biggest mistake retail investors make. One of the most common questions investors ask is, the PE ratio is 100. Isn't that too expensive? It's a reasonable question. But here's another question. Would you rather buy a shop earning 1 lakh rupees every year forever, or another shop earning 50,000 rupee today but doubling every 3 years? Suddenly, the answer becomes much more complicated. Because valuation isn't only about today's earnings. It's about how quickly those earnings can grow in the future. That explains why two companies in the same industry can trade at completely different valuations. The market isn't paying for the present. It's paying for expectations. Price is what you pay. Value is what you get. Warren Buffett once said, "Price is what you pay. Value is what you get." At first, those words sound simple, but they're incredibly powerful. Imagine buying a luxury apartment. One apartment costs twice as much as another. Without seeing either property, most people would immediately call the expensive one overpriced. But what if the expensive apartment is located in the city center, produces higher rental income, has better construction quality, and its surrounding area continues developing every year? Suddenly, the higher price begins making sense. Businesses work exactly the same way. Sometimes expensive companies deserve premium valuations. Sometimes cheap companies deserve to remain cheap. The real challenge is distinguishing between the two. Let's decode P/E ratio. People often treat the P/E ratio like a final verdict. High P/E equals expensive. Low P/E equals cheap. Reality is rarely that simple. Think of P/E as paying advance rent. Suppose a house earns 10 lakh rupees every year in rent. If someone pays 100 lakh rupees, they're paying 10 years of rental income upfront. Similarly, A/P/E ratio roughly tells us how much investors are paying today for each rupee of current earnings. But here's the catch. Current earnings don't stay constant, especially in growing businesses. That's why companies with strong growth often command much higher P/E multiples than mature businesses. Now look at Unimech. Unimech currently trades at a valuation much higher than many traditional engineering companies. Some investors immediately conclude it's overvalued. Others argue quality deserves a premium. Who's right? Actually, both may be right, because valuation depends on what happens next. Imagine buying tickets for a movie. One theater charges 200 rupees. Another charges 1000 rupees. Without knowing the movie, the expensive ticket looks unreasonable. But suppose the 1000 rupee ticket is for the World Cup final. Suddenly, context changes everything. The market is essentially asking one question. Can Unimech continue growing fast enough to justify today's premium? If the answer becomes yes, today's valuation may not look expensive several years from now. If the answer becomes no, the market may reduce that premium very quickly. The PEG ratio, a better way to think. Now let's simplify another popular concept. PEG ratio. It sounds intimidating, but it's actually straightforward. Imagine two students. Student A scores 95 marks. Student B scores 80. Who performed better? Most people say student A. Now suppose student A improved from 1994, while student B improved from 45. Suddenly, student B's improvement becomes far more impressive. PEG works similarly. It combines valuation with growth. Instead of asking, how expensive is the company? It asks, is the growth fast enough to justify that price? Growth businesses often appear expensive using ordinary valuation measures. PEG tries to provide additional context. Price to book, useful, but not always. Another popular ratio is price to book. Imagine buying a manufacturing factory. The machines, buildings, land, equipment, everything has value. Book value estimates those recorded assets. For banks and financial institutions, price to book can be very useful. But for companies like Unimech, something much more valuable often exists outside the balance sheet. Think about this. Can accounting books measure years of customer trust, aerospace certifications, engineering know-how, Long qualification history? Relationships with global OEMs? Not really. These invisible assets often create far more value than the factory itself. That's why high-quality engineering companies frequently trade above their book value. Discounted cash flow, thinking like a business owner. Now let's discuss the valuation method institutions love. Discounted cash flow. Don't worry about the mathematics. Imagine buying an apartment that will generate rent every year for the next 30 years. Would you value the apartment based only on this month's rent? Of course not. You'd estimate all future rental income. Then adjust today's purchase price accordingly. That's essentially what discounted cash flow tries to do. It estimates future cash generation. Then asks, how much is that future worth today? Notice something interesting. This method doesn't care about market excitement. It only cares about future cash. Which means even a wonderful business becomes a poor investment if purchased at an unrealistic price. Quality businesses rarely look cheap. Here's a lesson every long-term investor eventually learns. The market rarely offers extraordinary businesses at extraordinary discounts. Think about Apple, Ferrari, Microsoft, LVMH. Many people call them expensive for years. Yet those businesses continued creating enormous shareholder wealth. Why? Because their quality kept improving faster than investors expected. Does that mean every expensive company becomes successful? Absolutely not. But it teaches us something important. There's a huge difference between an expensive business and an overvalued business. The first may justify its valuation through execution. The second cannot. The valuation paradox. Now let's return to Unimech. The company currently sits in an interesting position. Its valuation already reflects optimism. The market clearly expects continued execution. That creates both opportunity and responsibility. Imagine a student who always scores 95%. Everyone expects excellence. Scoring 70 next year disappoints everyone. High-quality businesses face similar expectations. When investors pay premium valuations, they're effectively saying, we believe you'll continue delivering exceptional performance. If management succeeds, the valuation may remain high. If execution weakens, the market usually reacts much faster than the business itself. Markets don't reward perfection. They reward improvement. This is perhaps the biggest lesson in valuation. Many investors spend years searching for cheap stocks. Institutions often search differently. They ask, which companies are becoming better businesses? Because improving businesses frequently experience something powerful. Better products lead to happier customers. Happier customers lead to stronger earnings. Stronger earnings increase institutional confidence. Greater confidence changes market perception. And when perception changes, valuation often changes too. Notice the sequence. Valuation expansion usually comes last, not first. The real question isn't whether Unimech is expensive. The real question is much deeper. Can this company continue strengthening its competitive position? Can management successfully deploy IPO capital? Can acquisitions create value? Can aerospace demand remain robust? Can margins stay healthy? Can returns on capital improve as new investments mature? Because if those answers remain positive, today's valuation may tell a very different story 5 years from now. And yet, even if a business is fundamentally outstanding, the stock market doesn't move in straight lines. Sometimes prices rise long before fundamentals. Sometimes fundamentals improve long before prices. Why? Because markets aren't driven only by financial statements. They're driven by something much more unpredictable. Human psychology, fear, greed, patience, herd mentality, institutional accumulation, retail excitement. These invisible forces often explain why the same business can look ignored one year and irresistible the next. And that's exactly where our documentary takes its next fascinating turn. The invisible battle inside every investor's mind. Imagine you're standing outside a shopping mall on the day a new smartphone launches. People have been standing in line since early morning. Some haven't even seen the phone. Some haven't read a single review. Some don't know whether they actually need it. Yet everyone wants to buy it. Now ask yourself, did the phone suddenly become better because thousands of people stood in a queue? Of course not. The product didn't change overnight. Human psychology did. And that single idea explains almost everything that happens inside the stock market. Because despite all the technology, artificial intelligence, algorithms, financial models, the stock market is still driven by one thing: human emotions, fear, greed, hope, regret, patience, and sometimes pure imagination. Mr. Market, the emotional business partner, Benjamin Graham, often called the father of value investing, introduced one of the greatest mental models ever created. He asked investors to imagine that every day they receive a visit from a business partner called Mr. Market. Mr. Market is intelligent, but emotionally unstable. Some mornings he becomes extremely optimistic. He believes every business in the world will become extraordinary. He offers to buy your company at ridiculously high prices. The next morning, he wakes up depressed. Suddenly, he thinks everything is doomed. Now he's willing to sell the same business at a huge discount. Has the business changed overnight? No. Only Mr. Market's mood has changed. The stock market behaves exactly like that. Prices change every day. Businesses rarely do. The difference between a trader and an owner. Imagine buying a small restaurant in your neighborhood. You would focus on something far more important. More customers, better food, higher profits, lower costs, satisfied employees. Because you're running a business, not playing a guessing game. Now compare that with the stock market. Many investors buy shares on Monday and start worrying about Tuesday's price. They forget they own part of a real business. This is where institutions think differently. They don't simply ask, what will happen to the stock tomorrow? They ask, what will this business look like 5 years from now? That's a completely different conversation. Fear is loud, but patience creates wealth. Let's go back to March 2020. Markets around the world were collapsing. News channels spoke only about uncertainty. People sold good businesses simply because everyone else was selling. Now think carefully. Did companies suddenly forget how to manufacture products? Did engineers suddenly become less skilled? Did factories disappear overnight? No. The businesses remained. Fear temporarily overwhelmed logic. This happens repeatedly throughout history. Fear usually arrives much faster than facts. And greed often arrives much faster than reality. Why institutions buy slowly? Here's something most retail investors never notice. Large institutional investors cannot buy shares the way individuals do. Imagine trying to purchase every mango from a local fruit market. If you buy them all at once, every seller immediately raises prices. Large investors face exactly the same challenge. So what do? They buy quietly, patiently, over weeks, sometimes over months, sometimes even longer. That's why great businesses often appear to move very slowly before suddenly attracting widespread attention. Retail investors see only the final move. Institutions were often building positions much earlier. Think of an iceberg. Retail investors usually notice only the part above water. Institutional accumulation often happens below the surface. The psychology of missing out. Now let's discuss one of the most dangerous emotions in investing. FOMO. Fear of missing out. Imagine your neighbor buys a house. A year later, its value doubles. Suddenly everyone in the neighborhood wants property. Not because they studied real estate, but because someone else made money. The same thing happens in stocks. When prices rise rapidly, people stop asking, is this a good business? Instead they ask, how much higher can it go? Notice how the question changes. That's when emotion replaces analysis. Now think about Unimech. Imagine discovering this company before it became widely discussed. At that stage, most people ignore it. The business quietly improves. Customers increase. Factories expand. Management executes. Financial performance strengthens. Very few people notice. Then one day, the market begins paying attention. Articles appear. Videos are made. Social media starts discussing it. Suddenly everyone asks, "Why didn't I buy this earlier?" Here's the irony. The business probably became attractive long before it became popular. Popularity usually arrives after progress, not before. Confirmation bias, hearing only what we want. Let's imagine two investors. The first already owns Unimech. The second doesn't. Now both read the same annual report. The first investor highlights every positive development. New customers, expansion, strong margins, growth opportunities. The second notices only the risks, high valuation, working capital, execution challenges. Both believe they're being objective. In reality, they're simply searching for evidence supporting what they already believe. This is called confirmation bias. Our minds naturally prefer information that agrees with our existing opinions. Great investors constantly fight against this tendency. They actively search for reasons they might be wrong. Anchoring the price trap. Suppose you see a luxury watch priced at 5 lakh rupees. A month later, it's available for 4 lakh rupees. Most people immediately think, it's cheap. But is it? Maybe. Maybe not. The only reason it looks attractive is because your brain became anchored to 5 lakh rupees. Stock markets work exactly the same way. Someone sees a share fall from a previous high. Immediately they think, it's available at a discount. But here's the important question. Has the business improved? Or has the price simply fallen? Price alone tells us very little. Business quality tells us much more. Conviction is built, not borrowed. One of the biggest differences between retail investors and institutions is conviction. Retail conviction often comes from television, WhatsApp, social media, friends. Institutions build conviction differently. They study industries, meet management, analyze customers, read annual reports, understand competitors, review capital allocation. Only then do they decide. Think about constructing a bridge. You don't begin with the roof. You begin with the foundation. Investment conviction should be built the same way. Layer by layer, evidence by evidence. Until emotion no longer controls the decision. The opportunity cost nobody sees. Here's another lesson. Imagine planting a mango tree today. It takes 7 years to mature. After 2 years, you become impatient. You cut it down. Then plant another tree. 2 years later, you repeat the process. Will you ever enjoy mangoes? Probably not. Many investors behave similarly. They constantly switch from one exciting story to another, never allowing enough time for compounding to work. Patience is difficult because its rewards are invisible in the beginning. But over decades, it often becomes the most valuable investment skill. The quiet transition. If Unimech continues executing well, something interesting may happen. The market's perception of the company could gradually evolve. It may move from being viewed as just another engineering manufacturer to being recognized as a specialized global precision engineering business. That transition doesn't happen because of excitement. It happens because consistent execution slowly changes investor confidence. Markets eventually notice businesses that continue improving, sometimes slowly, sometimes suddenly, but almost never randomly. And this brings us to one final mystery. If psychology explains why prices move, and fundamentals explain why businesses improve, how do these two worlds connect? How does a stronger business eventually become a stronger stock? Why do some companies experience long periods of quiet accumulation before powerful trends emerge? Because fundamentals and technical behavior are not enemies. They are often two chapters of the same story. And in the next chapter, We'll bring those two worlds together, showing how business performance, institutional behavior, and market structure combine to create the journey investors eventually see on the price chart. When business quality meets market behavior, imagine you're standing on the beach. Every few seconds, a wave crashes onto the shore. Some are large, some are tiny, some disappear almost immediately. If someone watched only the waves, they might think the ocean is completely unpredictable. But now imagine looking much farther away, beyond the waves, beyond the foam, toward the horizon. There, you notice something different. The tide itself. Unlike the waves, the tide changes slowly, patiently, almost silently. And yet, it determines whether every wave reaches farther inland or falls short. The stock market works in exactly the same way. Daily price movements are merely the waves. The real business trend is the tide. Most investors spend their lives watching waves. Institutions spend their lives studying the tide. Why charts don't move first? Here's one of the biggest myths in investing. People often believe charts predict the future. In reality, charts usually tell us what investors are collectively beginning to believe about the future. Think of smoke rising from a chimney. Does the smoke create the fire? Of course not. The fire came first. The smoke simply revealed what was already happening inside. Similarly, a strengthening chart doesn't create a stronger business. It often reflects improving confidence in that business. The sequence usually looks something like this. A company improves its products. Customers place larger orders. Revenue begins growing. Profits improve. Management executes consistently. Institutional investors notice. Demand for shares slowly increases. Only then does the chart begin telling a different story. The chart isn't leading. It's translating thousands of investment decisions into one visible picture. The silent phase nobody notices. Every successful business goes through an interesting stage. A stage where almost nothing appears exciting. The company is improving. Factories expand. Customers increase. Margins stabilize. Management executes. But the stock barely moves. Many retail investors become frustrated. Nothing is happening. Actually, everything is happening. Just not where most people are looking. Imagine planting bamboo. For years, almost nothing appears above the ground. Then suddenly, it grows astonishingly fast. Did the bamboo become magical overnight? No. It spent years developing its root system. Businesses often follow the same pattern. The strongest price trends are frequently built upon years of invisible preparation. Understanding accumulation. Let's simplify another market term. Accumulation. Forget the jargon. Imagine a bookstore receives only 10 rare books every week. One collector wants all of them. Would he purchase every copy on the first day? Probably not. That would immediately attract attention. Prices would rise. Instead, he quietly buys one today, another next week, a few more later. Months pass. Most people don't even notice. Eventually, there are very few books left. Suddenly, prices begin rising rapidly. What happened? Demand didn't suddenly appear. Demand had been quietly building all along. Stock markets often behave the same way. Professional investors usually accumulate positions patiently. By the time everyone notices, much of the buying has already happened. Demand and supply, the simplest law in markets. Forget technical indicators for a moment. The market ultimately follows one timeless principle: demand and supply. Imagine there are only 10 concert tickets left, but 100 people want them. Prices naturally rise. Now reverse the situation. 100 tickets remain. Only 10 buyers appear. Prices fall. Shares work exactly the same way. When confidence in a business improves, demand gradually exceeds supply. That imbalance eventually becomes visible on price charts. Not because charts possess magical predictive powers, but because they visually record human decisions. Now think about Unimech. Let's return to our story. Imagine you're a global fund manager. Every day, hundreds of companies compete for your attention. You don't buy shares simply because a chart looks attractive. You ask deeper questions. Is the industry growing? Can management execute? Are margins sustainable? Is the balance sheet healthy? Can capital allocation create long-term value? If enough answers become positive, something interesting begins. Your interest changes from curiosity to conviction. And once conviction appears, buying slowly begins. That buying isn't emotional. It's methodical. Weeks become months. Months become quarters. Gradually, the market structure begins changing. Retail investors often notice only the final stage. Institutions usually participated much earlier. Trend is a reflection of confidence. Many people think a trend simply means prices are moving upward. That's only half the story. A trend is really confidence becoming stronger over time. Imagine opening a new restaurant. During the first month, only your friends visit. The second month, their friends begin coming. A few months later, online reviews improve. Soon, people you've never met start waiting outside. The restaurant didn't become successful overnight. Confidence spread gradually. Businesses experience similar journeys. The market slowly moves from skepticism to curiosity, to confidence, to optimism. Price trends often mirror that psychological evolution. Why corrections are normal. Now here's something many investors dislike. Even great businesses don't move upward continuously. Imagine climbing a mountain. Do you walk uphill every second? No. Sometimes you stop, catch your breath, adjust your equipment, choose a safer route, then continue climbing. Healthy businesses often behave the same way. Periods of consolidation aren't necessarily signs of weakness. Sometimes they're periods where earlier enthusiasm settles, while new buyers gradually replace short-term traders. Strong buildings require strong foundations. Strong trends usually do too. The difference between speculation and conviction. Let's imagine two groups buying the same stock. The first group buys because someone on social media says, "This will double next month." The second group buys because they spent weeks understanding the business. Now imagine the stock falls 20%. Who is more likely to panic? Usually, the first group. Why? Because borrowed conviction disappears quickly. Real conviction comes from understanding, not excitement. This is why institutions often appear calmer during market volatility. Their decisions were based on businesses, not headlines. When fundamentals and technicals finally meet, people often argue about which is better, fundamental analysis or technical analysis. It's like asking whether the heart or the lungs are more important. But they also increase execution responsibility. Scaling a business is often much harder than building it. The capital allocation test. Remember the IPO? Raising capital was only the beginning. Now management faces an even bigger challenge. Every rupee invested must eventually generate more than 1 rupee of long-term value. Imagine borrowing money to study abroad. If the education doubles your lifetime income, it becomes one of the best investments you'll ever make. If it changes nothing, the debt becomes a burden. Businesses face the same test. Investments should eventually produce stronger returns than the capital invested. This is where investors will closely watch whether new factories, acquisitions, and expansion projects translate into improving returns over the coming years. The working capital challenge. Earlier we discussed working capital. Let's revisit it. Imagine your bakery becomes famous. Demand doubles. Wonderful news. But now you must buy more flour, more milk, more butter, hire more staff, increase inventory. Meanwhile, large customers ask for longer payment terms. Suddenly, your business is growing rapidly, but cash becomes tighter. Growth begins consuming cash before generating it. This is one of the biggest operational challenges for engineering companies. As Unimech grows, improving working capital efficiency will become almost as important as increasing revenue. Because cash keeps expansion moving. Can the moat become wider? One of the most interesting questions investors should ask isn't, does the company have a moat? Instead ask, is the moat becoming wider? Think about a castle. A 5-meter moat protects it. Now imagine adding stronger walls, more guards, better watchtowers. The castle becomes even harder to attack. Businesses behave similarly. Winning one global customer is valuable. Winning 5 is even better. Expanding into semiconductors, defense, power generation, international markets. Every successful expansion makes the competitive position stronger. That's how moats widen over time. The institutional question. Imagine you're managing a pension fund. Your investment horizon isn't 6 months. It's 15 years. Would you buy companies based only on quarterly excitement? Probably not. You'd ask much deeper questions. Can this company still be relevant a decade from now? Will its products remain necessary? Can management continue learning? Will technological change help or hurt the business? Will barriers to entry become stronger? Those are exactly the questions institutions continuously evaluate. Because long-term investing isn't about predicting tomorrow. It's about preparing for 10 years from now. What must go right? For Unimech's long-term story to strengthen, several things need to happen. The aerospace industry must continue expanding. Customer relationships need to deepen. New capacity should be utilized efficiently. Acquisitions must create value rather than distraction. Working capital should gradually become more efficient. Returns on capital should recover as investments mature. If these pieces begin fitting together, the business itself becomes stronger. And when businesses genuinely become stronger, markets often recognize that improvement over time. The final reflection. Let's go back to the beginning of our documentary. We started not with a stock, not with a share price, not with a valuation. We started with an airplane. Because that's where Unimech's real story begins. Not on a stock exchange, but inside factories where precision matters more than publicity. Where engineers spend years solving problems most passengers will never know exist. Where trust is earned one component at a time. That's the quiet nature of industrial businesses. They don't usually become successful overnight. They become reliable first, trusted second, recognized third, and only then, sometimes, they become valuable. Perhaps the most important lesson from Unimech isn't about aerospace at all. It's about how wealth is really created. Wealth rarely appears because investors discover a stock. It appears because businesses quietly improve for years before the world fully notices. The market eventually rewards those improvements, but it never creates them. So the question isn't whether Unimech will become a larger company. The real question every thoughtful investor should keep asking is this. Can this business continue earning more trust than it loses, more capability than it spends, and more opportunities than it consumes? What happens after you buy the stock? Buying a stock feels exciting. Watching it go up feels even better. But staying invested, that's where the real challenge begins. Most investors believe the difficult part is selecting the right company. Ironically, that's often the easiest part. The real test begins after you press the buy button. Because from that moment onwards, the market starts testing your patience, your emotions, and your conviction. Not every day, every single day. The market is designed to shake you out. Imagine you've planted a mango tree in your backyard. The very next morning you rush outside. No fruit. After 1 week. Still nothing. After 1 month. Only a few leaves. Would you dig up the tree to check whether it's growing? Of course not. You understand that trees grow underground long before they grow above ground. Roots develop first. The visible growth comes later. Businesses follow the same principle. Factories are built before revenue increases. Employees are hired before production expands. Research is completed before products are launched. Customer trust develops before repeat orders arrive. But the stock market doesn't always wait patiently. Prices move every day. Businesses don't. The difference between price and progress. Let's imagine two different situations. Company A's share price rises 40%, but its profits hardly grow. Company B's share price remains flat. Meanwhile, its factories are expanding. Its customers are increasing. Its margins are improving. Its debt is reducing. Which company actually became stronger? The answer is obvious. Yet most investors celebrate Company A and ignore Company B because people naturally notice movement, not progress. Professional investors spend far more time tracking business progress than share price movement because eventually, price usually follows progress. What should investors actually monitor? Imagine you've invested in a restaurant. Imagine you've invested in a restaurant. You don't visit every year asking, "How much is my investment worth now?" Instead, you'd probably ask questions like, "Is the restaurant attracting more customers? Are reviews improving? Is food quality consistent? Is the owner opening profitable new branches? Are profits increasing?" Those questions matter because they reveal whether the business itself is improving. For an engineering company like Unimech, the questions simply change. Instead of customers walking through a restaurant door, investors monitor order books. Instead of opening new dining branches, they monitor manufacturing capacity. Instead of menu quality, they evaluate engineering capability. The principle remains exactly the same. The 5 signals that matter most. Let's simplify everything. Imagine you're only allowed to check 5 things every quarter. What should they be? Signal 1. Are orders increasing? Engineering companies survive on future work. Think of the order book as a doctor's appointment diary. If appointments remain full for months, the doctor is likely doing well. If the diary starts becoming empty, something deserves attention. Similarly, a healthy order pipeline often suggests that customers continue trusting the company. Signal 2. Are margins stable? Revenue alone tells only half the story. Suppose your bakery doubles sales. Wonderful. But ingredient costs triple. Electricity doubles. Staff expenses rise sharply. Despite higher sales, profits shrink. That isn't healthy growth. Investors, therefore, watch margins carefully. Strong businesses don't just sell more. They usually learn to earn more from every sale. Signal 3. Is cash improving? Remember, profits can sometimes look impressive on paper. Cash tells the truth. Imagine selling 10 luxury cars. Every customer promises payment after 12 months. Your accounting books show excellent profits. But your bank account remains empty. Can you pay salaries? Can you buy materials? Probably not. Cash flow often reveals whether reported profits are actually turning into money the business can use. Signal 4. Are customers staying? Winning one contract is exciting. Winning the next contract from the same customer is far more meaningful. Repeat business quietly tells investors something important. Customers trust the company enough to return. Trust is difficult to measure directly. Repeat orders often measure it indirectly. Signal 5. Is management delivering what it promised? Imagine hiring a builder to construct your dream house. He promises completion in 12 months. A year later, nothing is finished. Would you still trust every new promise? Probably not. Investors judge management similarly. If leadership consistently delivers what it communicates, credibility grows. If promises repeatedly miss reality, confidence gradually declines. Trust compounds just like profits. Ignore the noise. Every week, financial television produces new headlines. Oil prices, interest rates, inflation, currency movements, political debates, broker upgrades, broker downgrades, target prices, social media excitement, breaking news. If you reacted emotionally to every headline, you'd probably buy and sell constantly. Now imagine being the owner of a manufacturing plant. Would you shut down your factory because one television anchor sounded worried? Of course not. Business owners focus on operations. Stock traders often focus on headlines. Successful long-term investors try to think more like business owners. When should you worry? Patience doesn't mean blindness. There are situations where investors should become cautious. For example, suppose order growth begins slowing for several quarters. Margins continue shrinking. Debt rises significantly. Cash generation weakens. Customers begin leaving. Management frequently changes its narrative. None of these individually may be alarming, but together, they can signal that the original investment thesis deserves reevaluation. Notice the difference. You don't sell because the stock falls. You reconsider because the business changes. That's a completely different mindset. The market's emotional cycle. Every stock experiences emotional seasons. First comes discovery. Almost nobody notices the company. Then comes optimism. Positive results begin attracting investors. Next arrives excitement. Everyone starts discussing the stock. Then often comes euphoria. People believe prices can only move upward. After that, reality usually returns. Expectations become too high. Even good results disappoint. Price is correct. Fear replaces excitement. Eventually, only patient investors remain. This emotional cycle repeats across almost every market generation. The companies change. Human psychology rarely does. The discipline of doing nothing. Here's one of the strangest ideas in investing. Sometimes, doing absolutely nothing is the most profitable decision. Imagine you've hired an excellent cricket captain. Every over, you run onto the field changing field placements, giving instructions, switching bowlers, interrupting strategy. Eventually, you become the problem. Great management teams also need time. Factories take years. Customer relationships take years. Technology development takes years. Compounding takes years. Sometimes investors damage returns simply because they refuse to allow businesses enough time to execute. The exit checklist. Eventually, every investment reaches a point where investors should ask a difficult question. Why am I still holding this stock? The answer should never be, because I bought it cheaper. Nor should it be, because everyone on social media still likes it. Instead, ask yourself, has the original business thesis changed? Is management still executing well? Is industry demand still healthy? Has competition permanently weakened the company's advantage? Has capital allocation become poor? Are better opportunities available elsewhere? Selling should be based on business logic, not emotional attachment. The biggest mistake investors make. Here's perhaps the costliest mistake. Confusing volatility with risk. Imagine two houses. One house changes market value every single minute. The other only receives a valuation once every year. Which house is actually more volatile? Neither. Only one receives constant price updates. Stocks behave similarly. The market gives investors minute-by-minute quotations. Businesses don't become dramatically different every minute. Prices fluctuate much faster than business value. Learning to separate those two ideas is one of the biggest psychological advantages an investor can develop. A final thought before we close. Throughout this journey, we've discussed aerospace, precision engineering, semiconductors, financial statements, competitive advantages, management quality, industry trends, valuation, risk, growth, compounding. But perhaps none of those is the most important lesson. The most important lesson is perspective. When you buy a share, you aren't buying a blinking number on a screen. You're becoming a tiny owner of a real business. A business with engineers, factories, customers, machines, challenges, dreams, successes, failures, and thousands of decisions being made every single day. The stock price simply reflects what millions of people currently think. The business reflects what actually exists. Those two things often travel together, but not always. The investor who understands the difference, often sleeps better, makes fewer mistakes, and gives compounding the one ingredient it needs most: time. End credits. Every great company was once a small company. Every industry leader was once an unknown name. Every long-term wealth creator was once considered too expensive, too boring, or too risky. Whether Unimech Aerospace and Manufacturing Ltd eventually becomes one of India's great engineering success stories is something only time can answer. But one thing is certain: markets will continue changing, industries will evolve, technologies will improve, investors will come and go. Yet the timeless principles we've explored throughout this documentary will remain the same. Because in the end, great investing isn't about predicting the future. It's about recognizing businesses that are building it.
Don't forget to like and subscribe.